Hi, this is Anthony. Welcome back to my show. As always, before I begin, please click the subscribe button below. It really helps me out and it doesn't cost you anything. Thanks so much. Today I'm going to quickly look at one major stock and then an ETF that contains that stock. Today's stock is Verizon, and here's a little information taken from Wikipedia. Verizon Communications Incorporated, commonly known as Verizon, is an American multinational telecommunications conglomerate and is a corporate component of the Dow Jones Industrial Average. The company is headquartered in Midtown Manhattan, New York City, but is incorporated in Delaware. In 1984, the United States Department of Justice mandated AT&T Corporation to break up the Bell system into 7 companies, each a regional Bell operating company, commonly referred to as Baby Bells. Bell Atlantic, one of the Baby Bells, came into existence the same year. Headquartered in Philadelphia, it became the parent of various telephone companies with a trading area from New Jersey to Virginia. Eventually, its name became Verizon. In 2015, Verizon expanded into content ownership by acquiring AOL, and 2 years later it acquired Yahoo Incorporated. They were amalgamated into a new division named Oath Incorporated, which was rebranded as Verizon Media in January 2019 and was spun off and rebranded as Yahoo after its sale to Apollo Global Management. As of 2016, Verizon is one of the 3 remaining companies with roots in the former Baby Bells. The other 2, like Verizon, exist as a result of mergers among the fellow former Baby Bell members. SBC Communications bought the Bell's former parent, AT&T Corporation, and took on the AT&T name, and CenturyLink acquired Qwest, formerly US West, in 2011 and later became Lumen Technologies in 2020. Verizon's mobile network is the largest wireless carrier in the United States with 120.9 million subscribers as of the end of Q4 2020. A thumbnail sketch of their quarterly returns for the last quarter ending March 2022. Revenues went up a little over 2% to $33 billion. Net income was about $4.5 billion, down about 12%. Earnings per share were $1.09 in the quarter, down 14%. And the net profit margin was 13.65%, down also a little over 14%. I'll have a link in the show notes to the financials. As always, study the financials carefully before making any decisions to buy or sell. So let's look at a couple charts for Verizon. Year to date, it's down 3.72%. I have to admit that I found that really surprising. By certain measures of the stock market, we are in bear territory, and for many stocks, the kind that we all owned, you often see a 70 to 90% drop since the beginning of the year. So a drop of less than 4% is quite refreshing. For reference, the Dow Jones Industrial Average, which Verizon is part of, is down just a little over 14% year to date. Verizon currently pays a hefty dividend of 5.07% based on current prices relative to their dividends. Now that sounds great, but you want to be careful and not get fooled into making over a 5% return on dividends while losing 20% of the value of the underlying stock. Put very simply, don't go chasing dividends. This means don't simply look at the dividend yield and go for the high ones while ignoring that the underlying value of the stock is decreasing over time. I'm not saying that's what's happening with Verizon, but that's what's happening with lots of stocks that currently pay high dividends. Looking back 5 years, Verizon is up nearly 19%. And that is the total appreciation of the stock over the course of 5 years. So you divide that number by 5, and you get that it's only grown about 4% per year. And that's not taking into account dividends. So you do have to account for that. But not a very great return when we've had a tremendous bull market up until recently. For reference, the Dow Jones Industrial Average was up almost 45% over the past 5 years. So about a 9% per year increase. And again, that does not take into account dividends either. Let's just say for fun that you got shares in the predecessor to Verizon back when they split up AT&T, or you bought it at that time, which was in late 1983. From that time until yesterday, the company was up 550%, though that was, of course, 39 years ago. But if you would have bought and held on, you would have made a respectable 14% per year, not taking into account dividends. So that's pretty good. But if you look at the chart, there are plenty of very long periods in Verizon's history where the price was going sideways for many, many years. So let's say that you're interested in one or both of these. If you have an account with some type of brokerage, you simply can buy shares of Verizon using their stock symbol VZ. Let's look at today's other option. The Dow Jones Industrial Average is an index, but there are a number of ETFs which seek to match its returns by holding the underlying stocks that make up that index. One of those is the Spider Dow Jones Industrial Average ETF Trust, stock symbol DIA. I think many investors are familiar with the Dow 30, but I'll put up a long-term chart just for your viewing pleasure here. Looking at the chart for DIA, it goes back only 24 years, but if you held this ETF, it went up just over 307%, and in 24 years, that's roughly a 12.79% annual increase, not taking into account any dividends paid on this ETF. Yes, there are 30 stocks held in this ETF, and all now pay dividends, though the dividend rate is going to fluctuate quarterly based on what dividends are being paid by the underlying companies. But it's going to be much less than what dividend is currently being paid by Verizon. Remember, I'm not giving investment advice here, just entertainment. If you're interested in one or both of these, I'll have some links in the show notes where you can do further research on the financials, in particular for Verizon. I think that if you only had these two options to choose from and had to pick one, that would actually be a difficult decision to make. Verizon probably makes most of its money from its phone service, and people aren't going to get rid of their cell phones anytime soon. And whether they lose their job or the recession occurs or there's higher inflation or the stock market goes up or down, people are still going to use their phone and pay their phone bill monthly. If you're looking simply at the numbers and the historic trends along with dividend yield, Verizon does seem to be slightly better as an investment. The risk is the company might decide to make a purchase which turns out to be a large mistake and hurts earnings. There's been the trend fairly recently for telephone companies to try to get into media. We saw that with Verizon buying AOL and Yahoo. AT&T bought Time Warner, which incidentally had been combined with AOL at one point. And as I mentioned, the AOL division was bought by Verizon. I understand the theoretical attraction into buying legacy media companies with all their content, but if you look at the history of them, they rarely pan out financially for their acquirers. The Dow Jones Industrial Average, on the other hand, has 30 components, all of which give the leaders of those companies the opportunity to make good or bad decisions. But if a company does too poorly, then it could be removed by Dow Jones from the index and replaced with another stronger company. So there is a self-correcting mechanism for that security to get rid of bad components and replace them with better ones. For that reason, I think that if I could only buy one, that it would probably be going with the Dow Jones Industrial Average ETF. But that's taking into account that over the long run, historically, you probably would have made slightly more money with Verizon. And of course, you rarely have the option of investing in only one security. If you like both of these, put half your money in one and half your money in the other, or 25% of your money in Verizon and 75% of your money in the Dow Jones, or whatever combination you want. And of course, there's thousands of good stocks out there. Don't look at just these two candidates. As always, do your own research and take into account as many factors as possible when making a decision to adding to your well-diversified long-term portfolio. That's all for today. What do you think? Please leave a comment below. Thanks for watching and good luck in investing.